We have some big information about possible forced liquidations coming in the near-term future. This is a Fed report that just came out yesterday, December 10th, 2021. This is very interesting, and you guys will know why once we go over this, but we are heading into the most important Fed meeting we have had since they slashed interest rates from 2.5% to 0 in February of 2020. So we're not going to waste any time. Let's get straight into this video. Hit that like button for me, consider subscribing to the channel, and consider sharing this video to push this information out. So let's dive into this, guys. Like I said, this came out yesterday, December 10th. It says Archegos Capital Management, an investment firm heavily concentrated in a number of US and Chinese technology and media companies, defaulted on March 26, 2021, causing over $10 billion in losses across several large banks, principally outside the United States. The Federal Reserve, along with other U.S. and foreign regulators, initiated a supervisory assessment to understand the actions that led to Archegos' failure and to assess any risk management shortcomings at supervised firms. In light of the Archegos default and in the context of firms' relationships with investment funds, the Federal Reserve is issuing this guidance to remind firms of the supervisory expectations in integrity supervisory guidance on counterparty risk management, and to make firms and industry participants aware of practices that may be inconsistent with safe and sound banking practices. So they're basically highlighting the fact that a lot of these firms can just go to different banks, show them this portfolio value, which has actually been lent out previously by other banks, and go get more loans off of already collateralized money. This is a huge red flag heading into this Fed meeting, the most important one since February of 2020. We're going to continue on, and then we're going to talk about this as well as this derivative situation that is huge. That is a very bad problem, over $600 trillion problem. And Warren Buffett even says himself that the derivative market is going to be the thing that pops the everything bubble. This is going to be possibly the thing that crushes the financial industry. So it says this letter is intended primarily for use by banking organizations with large derivative portfolios and relationships with investment funds, as well as for supervisors as they assess and examine such institutions. This letter is generally not applicable to community banking organizations and banking organizations with insufficient derivative portfolios or relationships with investment funds. And also, why this is so important is because derivatives, while they are great in times of markets booming, everything's going good, once that slows down, capital is restricted, like what the Fed is going to do, those derivatives can really start to hurt you, because in the end, a derivative or a contract is a legal and binding obligation to sell or buy securities for somebody else on the part of that contract. So this is huge, guys, and this really ties into what we're going to talk about at the end of this video with the MOAS situation, how this could directly cause the MOAS. This letter is intended primarily for use by banking organizations with large derivative portfolios and relationships with investment funds, as well as for supervisors as they assess and examine such institutions. This letter is generally not applicable to community banking organizations and banking organizations with insufficient derivative portfolios or relationships with investment funds. The Federal Reserve is concerned, that is a huge word, they are concerned with practices where both at the inception of a fund relationship and on an ongoing basis during periodic credit reviews, firms accept incomplete and unverified information from the fund, particularly with regard to the fund's strategy, concentration, and relationships with our other market participants. These concerns are heightened where a fund client has a history of concentrated positions and losses. More generally, these practices present insufficient due diligence and may be inconsistent with safe and sound banking practices. Similarity, when initiating a relationship on an ongoing basis, firms should obtain critical information regarding size, leverage, largest and most concentrated positions, and number of prime brokers with sufficient detail or frequency to determine the fund's ability to service its debt. If a client refuses to provide this information, firms should consider whether it is consistent with safe and sound practices for them to begin or maintain a relationship with the fund, or whether they can use strong compensating measures such as significantly more stringent contractual terms to mitigate the risk. The Federal Reserve also is reminding firms that poor communication frameworks and inadequate risk management functions, as well as fragmented systems and ineffective governance, hamper their ability to identify and address risk. Risk management and control functions should have the experience and stature to effectively control risk associated with investment firms. Further, both oversight and business groups should review contractual terms and practices related to internal limits to assess whether they are commensurate with the risk to fund poses to the firm. Firms may consider reputational risk in making risk assessments. When they do so, they should establish a clear connection between such factors and specific financial decisions made by the firm with regard to a specific client. Finally, the Federal Reserve is concerned that firms may agree to margin terms inappropriate for their investment fund clients, failing to provide the adequate margin levels or sufficient risk sensitivity. Contractual terms that prevent a firm from improving its margin position or closing out positions quickly if a fund misses margin calls, even when presented with an increased risk profile at the fund, may be inconsistent with safe and sound practices. I do apologize. A lot of long words to try to get through without messing up. So I apologize for messing up a couple times during that. But basically what this is saying is shit is about to hit the fan in the derivative market. We're going to start tapering. We're also going to start tightening very soon. And why I say this and why this is so big to be coming out on a Friday after the markets were closed, as far as I am concerned, is one, sending a huge big flag to banks saying, hey, time is now to really control what you guys are doing, what kind of risk you guys are associating yourself with. Now, why this is all so very important, take a look at this inflation chart right here. We just had the highest inflation reading of 6.8% that we have not seen since 1982. What happened with inflation in 1982? It shot straight through the moon from 5% to 15% in a relatively short amount of time. And then it came right back down. Why did it come right back down? Because the Fed raised interest rates to almost 20%. They were criticized for doing this, but they basically had no choice to do this because inflation was crazy high. People's buying power was going to shit. Nobody wants to be the next Germany where you're burning money because it is no longer valuable, and wood is more valuable than your currency. The only way to do that is raising interest rates, and as we do know, we are at zero. We're at a 0% interest rate, or 0.08%, so virtually zero. What happened back here in 2017, 2018, and 2019? Fed Jerome Powell, once he was nominated, started to tighten. He started to raise rates pretty fast. Almost every single quarter, there was a rate hike increase. What happens to the overall market, and what happened during 2017 through 2018? Take a look at this. You've seen the first taper tantrum, first rate increase tantrum in the marketplace in January and February of 2018. Markets went down about 10 to 15%. Yet again, back here at the end of 2018 and the beginning of 2019, when Fed Jerome Powell really started to tighten down. We also had a trade war going on, but this is more in line, with a lot of analysts, what they have said, with Fed Jerome Powell raising interest rates as fast as he was doing. This was a over 20% crash. Really, this is like a bear market from the top to the bottom through really the last 3 months of 2018. Finally hit that bottom back here December 26th, the day after Christmas of 2018. But what was the inflation rate during this time? This will blow your guys' minds. The inflation rate in 2018 was only 2.5% at its peak. That is just crazy. That is insane, guys. We are almost 3 times higher than that right now. So they're going to have no choice but to raise interest rates sooner than what people expect, probably even as soon as January, February, or March of 2022. This is going to hurt the stock market. And as we do know right now, the stock market is only up and still remaining at almost all-time highs because people are crowding into a select few names which have the biggest weighting in the indices compared to your Dow Jones stocks, which have been doing pretty well over the past couple of weeks, but they're not really controlling a big percentage of the marketplace, maybe a couple percentage points overall, whereas your Apple, Google, Nvidia, Amazon, Tesla, Google, all these other stocks, they control over 20% of the broad markets, and they have been hitting all-time highs like Apple did on Friday alone, if not very close to all-time highs. Your mid-cap or even your larger cap stocks, but aren't like these stocks, not trillions of dollars, right? They have been selling off. So they are already in bear markets. The only thing holding this market up is these big companies. And that's where most of this derivative exposure is actually represented. A lot of firms, a lot of clients, they won't take trades just based off of any stock. If you're a smart hedge fund, at least, you want to be where the money wants to be. That's where you want to have your derivative exposure. And take a look at this chart. This is only from the second quarter derivatives of 2021. During 2008, there was $804 billion of exposure. Extrapolate this 100 times when you're talking about, obviously, how derivatives work. Usually 100 times leverage, right? An option gives you 100 times leverage. And that's where you see this whole topple over. Same thing, Q2 of 2021 as well as Q3 were also going through the roof yet again. So we're looking at a $600 trillion problem that is potentially about to boil over. It's just very weird and something you have to keep your eyes on when the Fed comes out to remind banks of the risks that they are taking on due to all of this derivative exposure. And like I said earlier, this is what Warren Buffett has warned about for a very long time. The derivatives market is a ticking time bomb. That is in his words. So how does this all play into AMC? Well, AMC and short positions, to take on a short position in AMC, you have to have collateral. You have to put that collateral down for that position. If shit hits the fan, if you start to see Apple, Microsoft, Google, Amazon, all these stocks that people are generally in and overweighted in, especially in the derivatives market, start to come down, you're going to see people have to cover on their short positions back like you've seen in 2008 when Volkswagen squeezed at the bottom of the markets. That was in October, just like we showed you guys. That was the bottom of the markets, and that's what really caused everything to happen, was that liquidity crunch and the liquidity that just dried up almost overnight. So that is the situation. Hopefully you guys are very excited. Shit is about to hit the fan, and I am very happy that I get to buy more AMC at an even cheaper price. And I do apologize for the stupid camera. It keeps closing its lens. I just got it. I'm not exactly sure how to stop it from doing that. So if it ever does that in a video until I fix it, that is why. Do not be alarmed. So that's going to be all for this video. Hit that like button for me. Consider subscribing to the channel, as well as make sure to check out the links down below in the description of this video. If you guys are not signed up with Public, they do not use payment for order flow whatsoever. So check that out. Go buy all the AMC you guys want. Send your orders to the lit exchanges where there's no manipulation or anything like that. It goes straight to the exchanges, and you actually get a much better price than what you get on Webull, Robinhood, Fidelity, TD Ameritrade, E-Trade, or any other brokerage. By doing that, you get a free share worth up to $1,000. I also get a free share. It takes about 2 or 3 minutes to do and sign up for and get that free stock. So you guys might as well check out the pinned comment as well. Leave your thoughts down below in the comment section. Love and appreciate you guys. Thank you for watching. I will see you in the next video.